I would like to start my presentation with a question. Okay, this is the question that I keep getting over the past 2 months, and we just had a discussion with a couple of our clients and colleagues just now. All right, the question is, because the stock market has been performing very well actually since April, right? So the question is, are we really out of the woods? Yeah. So if you look at the chart on the left-hand side, you can see. So this is the chart that shows, the stock market performance since Donald Trump took office, and compared with the previous presidents. Okay, the red line is Donald Trump 2.0. So you can see the market is up by more than 30% since April's Liberation Day, which is great, which is a huge rebound. So the question is, are we really out of the wood? Or is this just just another bounce before the next storm, right? I would say the answer to that question is far from simple, okay? Risk will always be there, and the impact of tariffs doesn't just end like this. Risk are still very much alive. They just keep evolving and evolving. All right. So going forward, I would say we are sort of heading into a period of fierce competition for capital. Okay. The capital sometimes could be, the competition could be sometimes very, very intense. Yeah. And because this is largely driven by the shifting dynamics of global trade. First of all, we got to understand trade and capital, they are just two sides of the same coin. Or you can say trade balances are mirror image of capital account balances. And we've had a very, very big imbalances to start with. So let's take a look of the left chart here. I just mentioned we had a very big imbalances to start with, right? And that is the United States. The United States has been the world's biggest trade deficit country in the world. It has been the case, right? So on the left chart, you see the black bar below zero. That is US trade deficit. And at the same time, other places like Japan, China, Europe, all of them are running huge trade surpluses. So in other words, what does that mean? In other words, the US has been importing tons of money from these countries to fund their spending and pushing up asset prices. The logic is very simple because let's say a US household or US corporates, they buy stuff. They import stuff from the rest of the world. Money leaves the US, right? But then because the unique status of the US dollar, money come right back into the US to buy US treasuries, to buy many other assets, right? So that's why I said the US has been getting tons of money from these countries to fund their spending and to push up their asset prices. So look at the NIIP chart on the right there. The black line below zero, that is the US NIIP. NIIP is the net international investment position. Okay, so think of it just like what you really own. Okay, that's your position. Okay, so for a country, a NIIP means the difference between a country, what a country owns overseas, and what foreigners own of this country. So a positive number means you are a creditor, and negative numbers means you are a debtor. So obviously, US is a huge debtor, right? Because its NIIP is negative 26 trillion US dollar. That's equivalent to more than 80% of the US GDP. So that means it has been receiving a lot of money from the rest of the world. It has been the case, okay? This is the model, that is how the world works over the past few decades. But the thing is, right now, this model is starting to look shaky. And one of the stabilizing forces is tariff, because tariffs are supposed to lower imports, meaning less money flowing out from the trade channel. And just like what I just mentioned, that also means less money flowing back to the US through capital flow. And this is happening exactly when the US needs a lot of foreign capital to fund their widening fiscal deficit and skyrocketing debt level, debt lows. All right. So this is the backdrop, and so if we look at this from this perspective, this is not a very good time to see trade tensions flare up. And perhaps this is not the biggest concern, okay? Perhaps this is not the biggest concern. The bigger risk might be coming outside of the US, from other countries. Let's take Japan. Why Japan? Because Japan is a massive international investor, yeah? It holds more than like 3 trillion. It holds actually 3.5 trillion overseas assets, right? It's huge. This is a huge amount. That's equivalent to about like 3% of global GDP. So that's why whenever Japanese investors start to move their money, everybody can feel it. The whole world can feel it, right? So going forward, one of the watch points, a very important watch points, is the inflation situation in Japan. Why is that? I believe many of you have been to Japan in the past 1 to 2 years, right? Hong Kong people love Japan, yeah? I went to Japan as well, but I go there for marketing trip with my team, okay? So I can feel the vibe. I see a lot of people, a lot of investors. Restaurants are not cheap anymore. It's getting more and more expensive. Prices are definitely going up. Inflation is definitely going up. So to some point, if the Bank of Japan, the Central Bank of Japan, has, if they force to hike interest rate again and again to curb inflation, that means more and more investors, especially Japanese investors, might bring back their capital, back to Japan, right? Because of the rising domestic yields over there. So that might not be a good news to the US, because that could mean less demand for the US treasuries, right? And the fact is that Japan is the biggest foreign holder of US treasury. It is holding more than 1 trillion, okay? So if that happened, that could send a shock wave, a real shock wave to the whole world, to the whole global financial market. Yeah, so I have a chart here on the right. You can see inflation is the red line, Japanese inflation, and then the black line is the benchmark interest rate in Japan. So to some extent, if inflation continues to rise, then the Bank of Japan might have to hike and hike and hike interest rate, just like what I have just mentioned. And then there is Europe. Okay, again, Europe has a lot of savings, both in the public and private sectors. And it has been exporting a lot of cash to the US. That is what's been happening. But again, this story is changing because we are seeing more and more people bringing capital back to Europe to fund their energy projects, to fund their military projects, because NATO leaders just promised to ramp up their military expenditure as much as 5% of their GDP. Right? And you can see the right chart there. None of them is 5% right now. Okay? For those countries that are very close to Russia, we are talking like a 3 point something or 2 point something. Okay? But for the rest, like 1 point something, or some of them even lower than 1%. So that would be a huge jump in terms of military expense. Okay? Huge increase. So that's why more and more money are and will continue to go back to Europe. Yeah, and adding to that complexity is China. I don't even have to put a chart here to talk about China, because everybody knows what China has been doing, right? It has been offloading US treasuries for so many years already. Okay, so what I'm trying to say is that if you add all of these three pieces together, Japan, Europe, and China, all of them are pulling out, right? So that would be a very, very powerful combination. And the fact is that in the past 8 years to 10 years, foreign holders of US treasuries are already trending down. It's already been decreasing. So given the powerful combination that I just discussed, this number here will continue to fall. That is pretty much for sure. And that is exactly happening when the US are, they're sort of desperate in need of money very badly, right, to fund their widening fiscal deficit, right? Because on the right, you can see what the US is now already paying more on interest payment than on military, right? The orange line is the interest payment. The red line is military expenditure. So you can see interest payment expenditure is already more than military expenses, right? And this is unusual. This is not usual. This is alarming.